Okay, so welcome back. Sorry for the technical disruption. So again, if you were new to us or you were new to this series, the Asian Wealth Community is actually a private wealth association. Predominantly, we are only looking at people who are accredited investors. We were born out of a crisis very much like what we have today. Back in 2014 and 15, Indonesia introduced the tax amnesty, and there was a lot of confusion and a lot of money that was involved in how do you go about complying with that particular rule and regulation. So we were born back then in 2015 with about 300 members. As of today, we've got about almost nearing 3,000 members, which is a nice growth. And it's not because we've done great stuff. It's because I think Asia has gotten really rich in the last 3, 5, 10 years. And now increasingly with the transition of wealth and the transfer of wealth even to the younger generation, a lot more people are getting interested in what's happening, with regards to tax, with regards to investments, and with regards to what's happening in the marketplace when it's a bit messy. All right. Okay, so as the association, we are very committed to education. So we've always done workshops, conferences. So this was one of the conferences we did in Sentosa a few years back. And we also are very involved with family office because they are the new wealth structure that's holding all this, wealth that's been created in the last 10, 20, 30 years, all right? While we were planning to have the High Net Worth Asset Allocation Forum in Singapore in March, April, this was not possible. So we've pivoted towards digital platforms. So we're doing all these workshops and sharing session reviews with expert speakers on topic that is near to your heart and that matters to you for your investments. And we started in May with Spartan Race, actually. Interesting about how the whole disruption with COVID, how is it going to affect the future of work and play. And also Luck Technology, which is owned by TikTok, so that was an interesting discussion about how technology and how not being able to come together. And digital assets in June were, again, I think Bitcoin is trying to come near to 10,000 or break 10,000. So it's the buzz is coming back. So people were wanting to understand what's happening in that space as well. All right. So for the High Net Worth Asset Allocation, we do intend to run a physical conference forum as soon as we are in phase 3 and we're allowed to. So we've actually got facilities now at Capital Land to do it. But we'll do the current session now by Zoom, and then when we're allowed, we'll reconvene into a physical conference in Q3 or Q4. Right? So the core topics we've been wanting to talk about is traditional asset class, which people have built their wealth, they know it well, and what is exotic, especially in the new economy. Right? So you have the equity bonds and property versus the crypto, the STOs, and the hedge funds, structured products, and what have you. And the other discussion is 2020 is a very messy year. So, some people may think it's a bull year, others may think it's a bear year. I personally think it's a kangaroo year. There's no trend line. You can't really trade the market one way or the other. And we'll cover the other two topics with our speakers as well on asset reallocation and risk diversion, which is very different thinking models, because the old model seems to not work, especially first half of this year. Okay, so thank you again to my speakers who are experts in their respective field, Kay from Saxo and Ash from AVM Fund. I will let them do their own introduction as they know themselves best. And Kay from Saxo as a global macro strategy. Ash is from the industry, but is already running his own fund. So we'll see what's unique about AVM Global Opportunity Fund. All right. Before I hand over to Kay to do their own self-introduction, this was one slide which has resonated, and we keep tracking as well. While this slide is a heat map of performance in asset classes, it's obviously more US focused and more listed focused. But you can see that there's actually no one category that stands out. It really depends on the seasonal cycle of investors' appetite. And although REIT seems to be a little bit more well received because of passive income, even it got hit in a few specific years, and for this year as well, because of the rental impact due to shutdown. So with that, I am most pleased to have Kay join us for an introduction. I will now stop sharing so that Kay could bring up his slide. Kay, over to you then.
All right, fantastic. Thank you so much, Eric. Appreciate the opportunity, both to you and then, of course, the High Net Worth Club, as well as the Asian wealth community as a whole. When I first heard about Eric and the High Net Worth Club, the Asian wealth community, and everything that has been built up over the last few years, I was pretty excited because it sounded like it was a good base of investors who are looking to learn and who also have an appreciation for talent in the wealth management business. And the first name that I was thinking about was Ashvin, or Ash, as I like to call him, from AVM. And very happy to say that we've managed to lock him in for today. So we appreciate his time. And he'll be walking us through why I think he is very, very well placed and one of the few outliers in the business in my kind of going on 15 years of doing this. And then I think we'll also touch on a little bit of kind of asset allocation and so on, which is key for, again, getting the context of why so few people with supposedly skin in the game fail to consistently compound money over time. But before all of that, let me just give a quick introduction of myself. Then we'll walk through a very quick overview of my current macro thoughts, which was something else that Eric wanted to share with the rest of you. And then we'll turn it over to the man of the hour, who's going to be Ashvin. So if you don't already know, my name is Kay Van Peterson, or KVP for short. It's my privilege to be the global macro strategist over at Saxo Bank, part of the Saxo Bank Group. I'm based out of their regional hub here in Singapore. We have offices throughout kind of the region, be it Sydney, Japan, Hong Kong, or Shanghai. We actually are a Nordic bank group, I guess I should say, stemming out of Copenhagen, Denmark, and have been in the business going on about 27 years. So we were actually one of the first pioneers on the brokerage side in regards to kind of going online first. But we're very much an agency player, so there's no conflicts of interest and anything like that, and just pure facilitator with clients stemming from anything from ultra high net worths to private clients, to hedge funds, to asset managers, to family offices, and even some corporates that may have hedging needs. And we obviously have a cross-asset, cross-product offering. So whether you're talking equities, bonds, currencies, or commodities, you can do it all under the Saxo Bank platform as a whole. My role here is wearing many hats, but predominantly it's looking at the markets from a macro hat, which is very top-down, rather than, let's say, bottoms-up fundamentals. So it's looking at everything from fiscal to monetary policy to geopolitical risks. But it is also, especially being a CMT, looking at charts, looking at price action, and being able to speak to people on both a very tactical kind of trading, shorter term kind of orientation, to a lot more long-term strategic, fundamental kind of multi-year allocation. So quite a diverse and challenging role, so to speak. I also hold a master's in applied economics and finance from the Copenhagen Business School, for those who are into the academic kind of background. And outside of finance, my passion is really, of course, the young family that we're raising out here in Singapore, jiu-jitsu, running. I'm a big sci-fi geek as well. And I also love connecting good people together. So talent and capital, talent and talent, capital and capital. It's one of these benefits of being in this great seat that I'm in. And, as I said, coming across Ash was quite a breath of fresh air, and we'll get into that. And also, I think at some point, Eric and I hope to have another get together where we will also look at another side of the alternatives, and this side it'll be on the venture capital side, and you can also be seeing some other pioneers that we feel stand out. So just going on in regards to kind of my current top views, just one page here, and basically it kind of goes back to before I even start to think about what's happening in the market, what should be selling and what should be bought. What do you do if you have a long bias in, let's say, equities or bonds? You have to know what your regime is. This is very, very key. Again, you have to remember that macro is not considering all the minute kind of details. It's not really, let's say, married around kind of valuation or stocks kind of PE. Macro is really about tailwinds and headwinds. It's about trends. And if you are really looking at the market seriously, and to be honest, anything in your life, even if you're running a business, things tend to have their pros and their negatives, things that kind of assist the situation and things that basically don't help the kind of situation. And that's macro. So macro is about knowing what trends are there, which ones are the more dominant ones, which ones are less so. And then, of course, the changing and the shifting in those trends. And the whole idea within macro is if you can follow and catch the 2-3 big kind of trends, it kind of tends to explain 80% of the moves that you'll be kind of getting. Obviously, if I was an equity analyst with a bottoms up approach, I'd be telling you something very, very different. But, start with what your regime is. I feel that regime we're in is where liquidity is king. If you look at the massive sell-off that we had and the huge, huge bounce back, and obviously we're moving on to new highs on things like the NASDAQ, it's really all liquidity driven. And I think we're in this perpetual liquidity tsunami that's set to continue, be it on the monetary policy or fiscal policy side. Both of these are basically open, which is, again, rarely the case. And we're basically all in from a policymakers and government perspective, which to me basically suggests that any kind of pullback, be it 5% on the S&P, or maybe if you're lucky, i.e., if you're looking to get in later, maybe 10%, is going to be met with more liquidity response. There's no way that the Fed or the U.S. Treasury is walking away from everything that they've done. And there's no way that the Senate, Congress is going to be doing that either way, especially when you're kind of this countdown towards the U.S. election. So both the Dems and the Republicans are going to still keep fiscal policy very, very kind of open, right? It is this environment where it is getting towards liquid and solvent. The business model, is now a lot more about keeping jobs rather than creating jobs. And we're basically not allowing a reset. State capitalism is pretty much here, whether you want to admit it or not. And, the economic model in regards to kind of price discovery has taken over. This is an MMT takeover, basically. I'm not trying to say this is right, but this is what it is. And again, remember, your objective is to make money. It's not to be right or wrong, but it's to consistently kind of make money over time. And I think there's still, this is something that I argue a lot with clients and also in interviews where people go, oh, things are highly uncertain. There's a lot of things that are unknown, and look at where the VIX is. And I actually push back, and I look at it differently. I actually think in many ways, things have never been more certain, because most of the times what we're trying to do when you're looking at markets, especially from a macro perspective, is you're trying to determine what the policy is. Are the central banks going to be hawkish? Are they going to be dovish? Are we going to be getting a fiscal spend or a fiscal kind of tightening? And right now, it's pretty much 100% that you're going to get continued accommodation on the monetary policy side and a continued accommodation of fiscal policy side. And fiscal policy, and this is actually definitely something that I got out of Ash's playbook, is a very, very strong, powerful force. And again, very few people have lived, if you could even argue that anyone has lived in what we're seeing right now. This is very much a one of its kind in regards to the amount of money that's being printed and put into kind of the markets as kind of a whole. So I think, it's actually a lot more certain than other regimes. I think you can expect more of the same in regards to yield curve control measures coming through in regards to, I believe that we will get to a point where we actually see negative rates in the US. And I think all fiscal policy roads lead to a city called infrastructure. So that's something that we will see globally. And we're going to continue to see more debt, more liquidity, and more, again, localization trends rather than, let's say, globalization trends, which, again, by itself is a fascinating kind of theme. In regards to just very broad strokes on asset allocation, I think for most people, at least active portfolio managers and CIOs that I know and respect, it's really about having a tactical overlay over the strategic. So that means you actually will be trading potentially a lot more actively than you normally would. The meta trend is still higher depth. And from an embedded interest perspective, and by that I mean the policymakers, the leaders of kind of governments, it's in their interest for lower yields, and it's definitely in their interest for negative real rates. And this kind of goes back to that old adage of, if you owe the bank $1 million, it's your problem. But if you owe the bank $100 million, it's the bank's problem. And you have to see where this debt is sitting. It's going to be sitting on central bank balance sheets, and it's going to be sitting on government balance sheets. There's no way in hell that they can have real rates be positive and going up, because that will have a twofold effect. It'll be raising their overall nominal debt obligation, and they'll be raising their overall interest obligation as well, right? So this is actually why there's a lot of people talking about inflation and deflation. But to me, the most important thing is where real rates are. And this is negative real rates, which means that their debt obligations will be less. And I think this is a key point that a lot of people kind of are missing on, and is a central part of my overall kind of thesis, right? So I kind of look at it as follow the liquidity. Technicals outweigh the fundamentals for now. And this could last for a lot longer than most people kind of think is possible. Gold, we're kind of around the 1800 levels. We're a little bit higher this morning as we're kind of recording this. I've been talking about this for months, but I think gold is heading much, much higher. I think easily over 2000 before the end of this year. And we could be going into kind of that 3000, 4000 range, by end of 2021, 2022. Interestingly enough, gold is one of the few things that's not making all-time highs. We've still not gone to the 1920 highs that we made in 2011 in gold, and we've finally broken through that 1750 key resistance area. And again, the whole theme here is yields lower, negative real rates, equity prices higher, US dollar lower, and financial repression still very much intact, i.e. given the liquidity is king kind of regime. Just on this point that it can last longer than you may think possible, just remember when we had Abenomics, which kicked off in September 2012, the Nikkei went up 150% in about 3 years' time. So this could last for a lot longer than most people expect. It's not necessarily just another 3 months or another 6 months, but it could be something that lasts well into 2021, and that's even without talking about kind of the industrials kind of side. So interestingly enough, tech and gold, you could argue, are the ultimate kind of debasement hedge in a world of exploding debt. Obviously, a lot of tech companies have very, very little debt, and obviously they've also been the ones that have pivoted easily, if not just having their outright business model being on kind of remote work and services. And this is just something that's going to be an advantage. It's going to continue to expand in this world of unrestrained central bankers and Robin Hooders. I think there's always opportunities, and that's always something to kind of bear in mind. I would put industrials. This was actually a theme that I initially got, funnily enough, off of Ashvin. I would put industrials very much on my radar. XLI is one of the ETFs. I think also ITA, which is another ETF for aerospace and defense, is interesting because either way, whether we have a repeat Trump presidency or Biden presidency, we're only going to see more fiscal spending. And I think the net result will still be very much infrastructure. And this is actually quite more exciting to me because infrastructure spend creates a real demand in the world. It's not just $1 trillion that is sitting on a central bank. It's, $1 trillion where copper has to be bought, iron ore has to be bought, steel has to be bought, concrete has to be bought, jobs have to be kind of created. So, when you look at the likes of Germany, where they're using about, 38% fiscal 38% of GDP in fiscal spend, it kind of tells you, a lot of what we can be expecting from, I think, some of the other countries. And Germany is traditionally a very thrifty and conservative from a spending perspective kind of culture, right? I think the Hong Kong regional exchanges are going to benefit hugely from the US-China listing spat. This has huge strategic tailwinds for Asia. Been talking about it for weeks in regards to kind of shares breaking out higher, first initially Hong Kong Exchange, but also, some of the banks there and brokers looking very, very interesting, as well as obviously the China kind of names. But this is going to be something where you're going to see a lot more liquidity being taken out of the US and brought here, and then going on forward, China, both tech as well as other companies, are not even going to bother to look into the US. They'll just list directly kind of in Hong Kong. And I think this also tells you that Hong Kong definitely has also still a lot of value towards China. I think there's definitely places where there's headwinds that I would be underweight, if not outright not having on kind of my book, or potentially be using them kind of on the short side. This is US and European kind of banks. There's going to be a lot of debt to be written out that they're going to have to eat the loss on. I think some segments of tourism may never come back, whereas others may see contrarian actually benefits. For instance, domestic tourism in China, I think, is actually going to explode, as well as, any kind of country that has a big enough kind of area to do that. And I think a lot of commercial property in especially places like New York or San Francisco, big kind of cities, they're going to be a lot more kind of challenged in countries that have a lot of land. I think places like Hong Kong and Singapore always have, the lack of kind of land towards their kind of advantage. But commercial property, I think, is going to be an area that is going to see some definite kind of disruption. And, I'm sure a question that a lot of people will be thinking about is all this debt in the system. Is it meaningless? Of course it's not meaningless, but again, just like kind of fundamentals, it doesn't matter until it matters. It will have to be addressed at some point, but that could still be easily 5, 10, 15 years away. And that could be, a change of haircuts, debt forgiveness, as well as kind of restructuring. And just one last thing, for the equity pickers of you out there, just something on valuation from our equity strategists. Basically on a PE basis, they basically say everything kind of looks expensive, generally speaking, compared to risk premium, which is on bonds. Actually, equities look fairly valued, and this is more a margin of bonds looking expensive, but actually compared to free cash flow to equity, they look cheap. The only thing I'll say and bear in mind here is if I'm correct that we are only going to see lower yields, then a lot of these valuation metrics for equities will basically make them seem cheaper than where they kind of actually are. So just something to kind of keep in mind. And this is currently my global macro kind of snapshot. We'll see if we have some time for some Q&A towards kind of the end of coming back to this. But before I introduce kind of Ash, just for those of you who are interested in the Saxo Bank Group and would love to hear some more of our research and kind of thoughts and views, we have a great Saxo Market Call podcast, comes out every morning European kind of time from my colleagues. You can also follow us on Twitter on all these different kind of handles here. My personal handle is the KVP one here. And then, of course, 2 places, either an analysis.saxo to get our research online, or actually just directly off of our actually kind of trading platform on Saxo Trader Go. So with that plug in, let me introduce Ashvin, or Ash as I like to call him. So I came across Ash, it was pretty much towards, I think, the start of when he launched AVM, which was the tail end of 2016. So he's the founder and CIO. And it's actually something that he founded together with his wife. So actually the V stands for Vanessa. And I think that's something that tells you also a lot more about kind of the character and the culture and the story of kind of what he wants to build out. But just to give you some context, because that's everything, in AVM's first full year of 2017, the fund returned about 19% with a sharper but +5. This is just amazing for a first year kind of performance, especially as during the first year of normal most funds, they make quite a few mistakes. It was also nominated for Eureka Hedge Best New Asia Hedge Fund award in 2018. And I think what also makes this outperformance even more impressive is not only the fact that AVM's mandate is as a low vol or low risk fund, but actually also a lot of other macro hedge funds and hedge funds in general in 2017 just had a terrible year. Most of them actually kind of lost money. So huge outperformance to the upside, right? I think also earlier this year, while a lot of other hedge funds floundered, as well as other just kind of traditional kind of long only investors, AVM was up for the first 5 months of the year. So this is quite extraordinary when you think about how big the market changes we had from January, i.e. we had just closed the big trade deal between the US and China. And then we obviously got into kind of COVID. So, this is from pre-COVID, sailing through the big drawdowns in the markets in February and March, where some stocks were down 40, 50, 60%, in some cases 80, 90% in the travel space. So, devastating kind of sell-off. And the funds still continue to also flourish in the bounce backs in April and May in very much risk-on environments. So this is something that you almost never see in hedge funds. Usually you see them outperform in one kind of market, and then obviously when the market changes the next month, you can see that kind of underperformance, right? And at least from my viewpoint, I think these are just a testament to the talent, skill, hard work, and I think the differentiating factor that Ashvin brings with AVM. He has over a decade's experience in the financial sector, pretty much began his career on UBS, where he's been working out of both Singapore, Hong Kong, London, and Switzerland, and predominantly started first doing structured products, which is a great way of getting you to think about kind of risk reward. And it's also something where you need a very kind of comfortable analytical kind of background, and then basically kind of got enhanced and upgraded towards trading FX and interest rate derivatives, eventually also running a prop book and also being responsible for a team. And then also prior to launching AVM, he also had a gig as the head of Asia Pacific trading FX options at Natixis, which is also a powerhouse of French European kind of bank, who are also notoriously very strong on the options and mathematical kind of side of things, and helped him lead to another kind of winning accolade. If you don't already know, he is a bit of a brainiac. I'm always teasing him about how brainy he is, but I tend to think of him as Singapore kind of royalty in regards to graduating and getting actually a scholarship from the government, and also kind of coming back and working under the Ministry of Finance here before going back into the business world, so to speak. And he also holds a Master's of Science in Financial Engineering from Columbia, one of the top schools in the US. And I always tease him that he's looking to build a basketball team because he has 4 loving kids with his wife. So, we got to raise capital for this guy. Ashvin's also a big fitness buff, runner, does a lot of high intensity and yoga, and also has a keen eye for great wines and any excuse to get on a plane to Japan. He's very much kind of game. So with that intro, which is very much my own, let me pass it over to Ashvin, who's going to walk us through AVM and, give us a little bit of a flair for the different investors he has, why AVM is different, and we'll take it from there. Ashvin, over to you.
Thanks a lot, Kay, for that lovely intro. Thanks, Eric, for inviting me to speak to your society. It's been an interesting year so far. I'd like to just tell you a little bit more about, after that intro, about why I've started this fund and what it's about. Kay, can we just go to the next slide? The executive summary. Yeah. So after about 10 years in banking, I decided to step out because I had put together an investment philosophy which was working, which I had been trading on my own. And I set up this fund because I felt there was a product that was missing in the market. Over the long term, we do hear how asset allocators tell you, just buy equities, you're going to make money over 10 years, 20 years, etc. But every now and then, you're going to have events like 2000, 2008, 2020, where there are big drawdowns. Over the last decade, I think we've seen quite a few drawdowns, which were north of 20%. And I think there's a framework, what I want to deliver to clients and for myself, because I'm one of the biggest investors in my fund, is equity-like returns over the long term, but with the volatility of a bond portfolio. So basically, basically a product which gives you returns which are superior to equities, but with a risk profile that is similar to an investment grade bond portfolio, right? So it allows you to sleep at night. You don't have any big drawdowns to worry about. And that's my investment philosophy. So the way I do that is I have combined a traditional top-down macro view on the markets, which most macro managers do, and I've combined that with a systematic investment process. And I think that's the key differentiator where I've removed a lot of the bias that traditional macro managers have, and I approach the markets in a very disciplined, systematic method, with a disciplined, systematic approach.
Ashwin, I think you just hit mute by mistake.
Are you okay now? Can you hear me?
Yeah, perfect.
Okay, yeah. And I think what I'm trying to achieve is to deliver an investment journey for my investors, which is very comfortable. There are two ways to getting to your destination. You can either probably take a very bumpy bus ride to your destination, or you can take a nice business class ticket to get to your destination. And my objective is to make sure that you get to the destination in the most comfortable way possible. So, it's a low volatility strategy. The returns I'm targeting are equivalent to global equity returns, and there's a strong focus on capital preservation. And I think this fund, over the last 3.5 years since I've launched it, has been through a very interesting investment period. I've been doing this for a long time, and I've never seen this before. We've had a bull market, then we had a bear market, and then we had a bull market, a bear market, and now a bull market again. And I'm quite happy that the fund has managed to get through this period and adjust its portfolio accordingly by looking at the data and the regime that we are in. And that's something that Kay alluded to just now. I'm very big about regimes because that dictates the asset allocation that I'm going to put in my fund. So how we perform today, yeah, so it's up about 41.5%. Its volatility is 5%. That's lower than what I just want to keep it below 8%, but we managed to get the returns with lower volatility because of the asset class mix, the Sharpe ratio, which is your risk adjusted return, which is something I focus on a lot. And that comes back to what I was talking about, the journey. The higher the Sharpe ratio, the more comfortable your journey is and the less drawdowns you have. And the correlation to the S&P 500 is almost zero. That's very important to me as well, because I'm trying to make money in both bull markets and bear markets. And given we've been spending half the time in bull markets, half the time in bear markets over the last 3.5 years, the correlation has been close to zero. And that's the objective here. Okay, go to the next slide. Okay. Yeah, we can skip that. We can go to the next slide. Next one. Yeah, okay. So what do we trade in? So for me, in order to make sure this strategy works, and I have liquidity, I only trade in the most liquid markets out there. The reason being, again, this first quarter has taught us many things. It's very easy to get into a trade during quiet markets, but getting out of a trade when there is a deleveraging event is very difficult. So for me, it's very important to focus on markets where they have deep options. In general, a deep options market, which allows you to hedge exposures, and also very good liquidity so that you can get out during trying times. So just to give you some context, during the first quarter this year, the liquidity in S&P and Treasury futures was down 95%. Yet, even being down 95%, it was okay trading it. If any other asset class was down 95%, you would not have been able to get out. And we've heard all these horror stories in corporate bonds where if you had to get out of a corporate bond, you'd be crossing a spread of 20 points. So we try to make sure that we don't get caught in such situations. So there are ways of doing that. You could still get exposure to corporate bonds, but there are different ways of doing that to where you can get liquidity. So what instruments do I trade? I trade futures, I trade FX, I trade corporate and government bonds, and I trade equities. Underlying is traded. It's a cross asset mandate. So I trade commodities, I trade equities, I trade bonds, and I trade currencies. Now, I think that the products I trade are very vanilla. They're available to all investors. I think the secret sauce is knowing when to invest in a certain asset class. And that comes down to my investment philosophy, which is based on the regime we are in. In a bull market, you invest in certain assets. In a bear market, you just invest in certain assets. And in a deleveraging event, you invest in certain assets, right? I'll walk you through that in a bit. The target risk characteristics I'm looking at is 8% target volatility. And that's the average volatility of a bond portfolio. If you look over the long term, equities will be closer to 16%. I'm looking at a Sharpe ratio of 1.5. So I'm trying to deliver about 12% per annum for investors. And the main thing is that my simulated drawdowns are always going to be limited. I'll walk you through that through my risk management. And the correlation to equity markets will probably be zero over the long term, because over the long term, when there's a bull market, I'm going to go with equities. When there's a bear market, I might be short equities, or it might be asset classes that perform when equities don't. So that's the way I look at it. Typical holding periods, 2 weeks to 3 months. When you take a macro top-down view, things don't change that quickly. In the last 3.5 years, they have been changing a lot quicker than they used to. But that strategy is okay; it can handle that. And I never trade just based on charts. I wouldn't buy an asset just because it looks bullish on a chart. I need to know why I'm buying it. It needs to fit within my investment philosophy. And then I'll look at the price signal and the volatility and decide whether I want to buy it. Okay, next slide, please. So the investment process. So you need something that's scalable and repeatable. And I think, you've heard that before, but it's extremely important. And the way I've put together my investment process, it can be used across asset classes and across regimes, right? So the first thing I always do is, as a top-down macro investor, is look at the relationships between asset prices and the macroeconomic drivers that are driving these asset prices. Some of the key metrics we do follow, as you can see in the slide, GDP growth and inflation, because these two drive corporate earnings and profits, and they drive the economy. And then liquidity and fiscal policy. Now, liquidity was not as important, say, 30 or 20 years ago. Ever since the GFC, liquidity has become one of the main drivers of the market, because if you look at an individual, he's got, say, $100, he needs to allocate that liquidity to equities, to bonds, and to cash. And the more liquidity there is, the more money that's going to flow into assets like bonds and equities, right? So that liquidity, the expansion to a central bank balance sheet since the global financial crisis has led to a very fast money supply growth, which has only accelerated over the last 3 months. So, that factor is still going to be one of the main driving forces in the markets. Fiscal policy we have not had for a long time. We are now going into that phase over the next decade. I think fiscal will play a bigger role than in monetary policy, because monetary policy has probably reached its limits. The way I look at monetary policy going forward is just going to be there to support fiscal policy. So the government needs to issue more bonds to support the economy. Liquidity is going to be there to support it. So these 4 things sort of frame the macro landscape in any country. And based on that, we use a lot of data in our investment process. So I run 50 years of data to look at all the different trades that do well in different regimes. So an example of a regime would be in January, when we walked into 2020, liquidity was ample, inflation was controlled, GDP growth was picking up. And that sort of environment, you really want to be long cyclical stocks. You want to be long equities, because liquidity and growth are pushing asset prices higher. And that's what we saw. But as we went into February and March and the lockdown started, it was obvious that GDP growth was going to take a step back and that inflation was going down even further. And now we've come out of this with all the central bank support. And now GDP growth is going to pick up from here, probably, maybe at a slow pace, but it's going to pick up. Liquidity is strong, fiscal policy is strong, but inflation is probably a story for another 1 or 2 years. While, you need there's going to be an inventory overhang and a demand output gap to come to sort of close up over the next 12 months before we see any inflation. So the hypothesis is, for example, if I think we're now in a GDP, in an environment where growth is going up and liquidity is strong, I'm going to say maybe we should buy tech stocks, liquidity, or cyclical stocks in North Asia, for example. That could be a hypothesis I have right now. And then I'm going to run that hypothesis through 50 years of data to make sure that what I'm saying actually holds true, right? So there's no bias. If I go through different periods in time over the last 50 years where we're in a similar situation, I look at what asset classes perform the best. And if now my top-down view says that this is going to do well and is backed up by data, then I'm going to put that trade on, right? So it's always a hypothesis, and then you test the hypothesis. If it fails the test, I can't do the trade. No matter how much I like it in my brain, I can think about that trade. I can only put that trade on if it passes the test. Then how do we structure the trade going from there? That's the interesting part. So it all depends on the conviction level behind the trade. So I look at all the supporting macroeconomic drivers that are going to support my trade and how likely I think they're going to continue in the future. The other thing I look at, which is extremely important in a market with very high liquidity, is market positioning, because things can sell off pretty quickly when markets are all trading the same, when investors all have the same point of view. So something I pay for. There are a few service providers that actually give you positioning, and it gives you an idea of how much you want to allocate to a trade. An example would be the NASDAQ, a technology play. It is the consensus trade, doesn't mean it's wrong. You just have to be aware that everybody has that trade on, and an unwind in this trade can be brutal. So how you execute a trade like that, you could buy the stock, but you should always buy some options to protect it because the unwind can be brutal, right? It's how I think about it. If the positioning is not very high, you might put a bit more capital to this trade because the upside is much bigger, right? So you're always looking at conviction and positioning. And then I use a proprietary model that we built to decide how much I'm going to invest in this trade. And a lot of that is based on a philosophy. I start a trade by thinking about how much am I willing to lose if I'm wrong? And I don't think many people approach a trade that way. They're always thinking of how much they want to make. If you go in knowing how much you're willing to lose if you're wrong, because you will be wrong once in a while, you're okay. You have no emotions. If it goes against you, you're fine. You don't stop out early, you stop out when you need to, and you let the trade run, right? It's a very important thing to do and an exercise. It takes some time to do. Even as an individual, you should be looking at every investment that way. How much am I willing to lose if it goes wrong? Because if you don't do that exercise and things go wrong, you generally end up hanging on to very bad trades for a very long time, and your capital is misallocated, right? So that's a very big thing for me, because if you take big losses, it takes a long time to come back from it. The compounding effect is huge over a long period of time. You don't see it from month to month, but over 10 years, avoiding big drawdowns means that your overall returns will be very high. Now that I've decided on the size of the trade, how I'm going to scale in and scale out of the trade, I need to make sure it fits within my portfolio. We had looked at the previous slide. I have target risk characteristics on the volatility, the return profile, etc., max loss of the total portfolio. So I need to make sure that this trade is not just like every other trade in my book and it's going to increase the risk, right? So I put the trade in, I run it through a lot of simulations. I have about 20 simulations which I run the portfolio through to see how it would perform in different regimes. This last 5 months is great, or 6 months has been great data for the fund, because what you've seen is the markets have, sorry, just give me a second. What you've seen is the markets have been going through a bull market, a bear market, and a bull market. So you can run it through a lot of these scenarios to see how your portfolio would have survived through the first 6 months of this year, right? So you can see what the main risk factors are, and then you can decide how you're going to hedge those risk factors. So I can give you an example. When I went in January, I was very long stocks because I felt the market was basically the conditions were very supportive for stocks. Liquidity was ample and growth was picking up. But I did look at the positioning data and I noticed that it was very highly positioned. And if we had any sort of black swan event or a deleveraging event, markets were going to get wiped out pretty quickly. So in that situation, the easiest thing for me to do was to put on some hedges just in case that happens. I didn't think it was going to happen, but just in case it happens, options to protect a black swan event were very cheap because everybody was bullish. Nobody thought it was necessary to buy any put options, right? So buying a 10% out of the money equity option only cost me like 0.1%. These are the kind of cheap hedges that I always look out for in the markets because, you know, 0.1% doesn't cost you very much. You know, a lot of people like to sell options. I generally buy them, and I'm always looking for cheap hedges because when a black swan event hits, it gets really expensive. So what happened in January when it came to February and the lockdown in China happened, I took off all those equity positions and I just kept those put options because it felt basically I knew that when you move from a very risk-on environment to people getting out of risk, the number one thing that happens usually is the deleveraging event where people sell everything. You know, I think many people have, you need to make sure your portfolio is ready for a deleveraging event like we had in March, where there's no safe place to be other than the US dollar. And I think that's one aspect of investing that you always need to be prepared for. So for me, in that period, I think a lot of people will tell you this is a balanced portfolio. Sure, the correlations are there. It's a balanced portfolio for maybe 9 out of 10 days, but there's always going to be that one day where everything sells off. So I make sure I put it through all these different regimes: deleveraging, Russian default, um, the 2008 financial crisis, LTCM. I just see how the portfolio behaves. I see where the pain point for the portfolio is, and I hedge it just in case it happens. And what is interesting about this exercise is because I have the positioning of the market, I know where the weak point of the market is. So I know if something happens, I know I have a good idea of where the market's going to go. Can I go to the next slide? Okay. Right. So I think, you know, we've gone through the investment process, which is really a mix of fundamental top-down and a systematic investment approach. The next point is really the risk management, which differentiates this fund from most funds out there. And it's something I alluded to just now. When we look at risk at AVM, we look at how we put on a trade and why this trade goes wrong. So I trade based on regimes. If it's a growth, we're in like an inflationary growth period, I know what assets I'm going to invest in. And the only reason I'm going to be wrong is because my view of the economy is wrong, right? So I look at what happens to my portfolio if, for example, we're going through a growth phase and we suddenly jump into a deleveraging phase. I look at what happens to my portfolio if we're going through a growth phase with no inflation to a growth phase with a lot of inflation, which is a different regime. So I look at that risk and I see how much money I'm going to lose if I'm wrong on the regime. And I make sure that if we ever change from one regime to the other, my downside is capped. And that's the way I manage risk. And the way to do that is to go through 50 to 100 years of data to see how portfolios do when they transition from one regime to the other. The easy part about risk management is looking at correlations and volatilities during a stable period. So if you were managing your portfolio from 2016 to 2020, it was easy. You just said, okay, I'll just buy bonds. It would hedge my, or gold, it would hedge my equity position. Or I would just buy something else which would hedge my equity position. But overall, it should be fine. But every now and then you have a deleveraging event like we had in March, we can wipe out a lot of capital, especially for people who have leverage, right? If you look at a lot of the levered funds out there, they would have lost money during this period. But now coming back up is difficult because the leverage has been taken down due to high volatility. So traditional risk management looks at historical volatility, historical correlations, builds balanced portfolios. But there's a big flaw to that because all these correlations change when you go from one regime to the other. So I think that is the unique thing about the AVM approach, where the risk management system is robust to regime shift. And again, this year was a good year to look at how that worked because the fund went from risk on to risk off to risk on and managed to get every month was positive in the first 5 months, right? It's just looking at the regime we're in, understanding what the macro drivers are for asset prices and shifting from one asset class to the other. Like we all have access in the markets to bonds, equities, commodities, and currencies. But the trick is knowing which asset class to invest in based on the regime we're in. And that's how I do it with the AVM fund. So we've successfully stayed below 8% realized volatility. So we've maintained a low volatility, very comfortable ride for our investors. Yes, Jay, why don't you go to the next slide? So these are returns for the till May of this year. You know, if you look at the returns, the monthly returns are always within plus minus 3%. We had one big month in August where we are up 4.5%. But that's the sort of returns I want. Steady returns throughout the year and avoiding big drawdowns. What you get from that is a compounding effect that over the long term, you're going to probably outperform equities because you will miss those big drawdowns. So for example, a guy who was long the S&P would have to now claw back all those returns over the rest of the year to probably break even, right? From where they were at the start of Jan. This has been exceptional. The rebound in equities this year has been exceptional, but in general, bear markets take a couple of years to come back, right? I think this has been slightly different. I think the unprecedented liquidity and fiscal policy from the governments has sent this up pretty quickly. But in general, compounding, you're not going to see these kind of rebounds in markets when you have a big sell-off. So if you look at the returns, I think that's what I'm trying to achieve: stable returns, returns throughout the economic cycle, whether there's a bull market or a bear market. When I do lose money, you know, everyone does have trades that go wrong. It doesn't lose you too much money. So the idea is to protect your downside if I'm wrong, and then ride the upside if I'm right. I'm looking to make 10 to 12% per annum, and you know it's going according to plan right now. We are outperforming the hedge fund index in the market. I think what's different, as Kay mentioned, is I'm not the traditional macro guy who says, okay, this is a bear market, I just stick to my view for the next 12 months. I actually look at data a lot. I have trigger points and I trade based on that. So if things change, I'm nimble, right? So I think it's very important to be nimble in this market because there's so many drivers, and it's very important as well to understand what those drivers are. And we spend all our time looking through data to see what drives a certain asset class, and we just follow that. And if that's in line with my top-down macro view, then I will put on the trade, right? And the risk management is important as well. So I think you can see that there will be a drawdown, but that compounding effect, you can see after that drawdown in 2018, it just picked up very quickly. If we had a big drawdown of 30% or 25%, like a lot of funds did in 2018, it would have taken a lot longer to pick that up. The next slide is going to be interesting. I just push that. So how does this fund compare to global benchmarks? I think many of you are used to investing in equities, in bonds, in currencies, commodities. So let's go to the first one, so the annualized returns. So if I compare the fund's returns since inception against the against bonds, equities, high yield bonds, government bonds, and commodities, it has outperformed the global equity market. It doesn't look like that when you look at my returns in the previous slide because it looks like it's steady returns, but not having that big drawdown in 2018 and that big drawdown this year has allowed the fund to outperform equity markets. If you look at the volatility of the fund, it's actually quite low right now, but it's around the volatility of an investment grade bond portfolio. So a lot of us like to hold investment grade bonds in our portfolio because it gives you steady returns without too much drawdowns. That's the sort of journey that I want my investors to have, that sort of feeling. But the returns I want to give you are returns of equities. So I'm taking the best of in the returns world, and I'm giving you the experience of an investment grade bond fund, right? That is my objective. And I think that is possible only because of the risk management framework I put together, which allows you to cut your losses when you're wrong and ride your gains when you're up. And that's how I think about investing. The Sharpe ratio is the risk-adjusted returns we talked about. So that's much higher than most other asset classes. And that again comes down to risk management. And in terms of the maximum drawdowns, it's about the same as an investment grade bond portfolio, right? So again, the journey of an investment grade bond portfolio, but the returns of equities. Your next slide, please. So this is interesting. So, I mean, I guess you have access to all these different asset classes, but how did I do it, right? How did the AVM fund do this? So you can see in the beginning of when the fund first launched, the correlations, these are correlations with all the different asset classes we have out there. You can see in the first part of so I would say the first half of the fund's life, the first, say, 12 to 18 months of the fund, we were highly correlated to equities because our models told us that growth was picking up, especially after the tax cuts in the US. Things were, and Europe was getting its act together during that period in 2017. Things were doing well. So we were long risk in general, and that's how we managed to deliver 19% with a very high Sharpe ratio in 2017. Going into 2018, things started to get a bit hairy, and you can see our correlation to stocks started dropping. And by 2019, we had gone negative, right? Because we had increased our correlation now to bonds, government bonds, where yields were very high in 2018, and the safe haven assets started to outperform. And that usually lasts for quite a bit. And I suspect we're coming probably almost to the tail end of this trade, maybe another 6 to 12 months, but it's still an asset class that is performing. If you look at our correlation to commodities, again, it's been flipping depending on whether it's a pro-growth environment or a slow growth environment. But the whole idea of this slide is to tell you it's not a static portfolio. Anybody who tells you that I have a balanced portfolio which I do not have to touch, which is going to perform over time, is not telling you the truth. And I think March this year has shown you that there's no such thing as a balanced portfolio where people need cash. There's only one asset class that people go for is the US dollar. So for me, in March, my deleveraging portfolio was just puts on the S&P and long the US dollar. And that's two trades that always work in a deleveraging environment because people are running for cash, right? It's only when liquidity backstops are there, when the Fed comes in, then you can start thinking about a balanced portfolio because there's a lot of liquidity there. People need to invest. But during a deleveraging event, you just always have to be careful because there's no such thing as a balanced portfolio. So I think that about sums it up. I think I can hand it over to Kay now. Oh, sorry. Let me just go through that last bit. Maybe just to round up why we think this fund could be of interest to you. I think this fund appeals to someone looking for steady returns, something with less volatility, something that delivers equity-like returns without any of the headaches of the drawdowns in the markets. It's got a low correlation to the S&P 500. So I think where it sits within a portfolio is maybe you need about 20% of your portfolio that's invested in uncorrelated products. So in a time like this, many of our investors have been, it's one of these investments that's helped them get through this tough period when the equities and bonds were not doing well. So this was not correlated to that and performed well. It's an investment process which is scalable and repeatable. So as this fund grows, there's nothing I have to do. I'm just sticking with this strategy which has worked over the last 3.5 years. Yeah, I think that sums it up.
All right, that's a fantastic overview, Ash. Thanks for that. I just have one question before I pass it over to Eric, who I'm sure is going to have a few. But obviously, the hedge fund space has a bit of a reputation for, people charging for the privilege of underperforming on other people's kind of assets. So actually very little kind of skin in the game. But, just from context, from your net worth perspective, how much of your wealth is actually tied into AVM from a percentage perspective?
About 70%.
About 70%. All right. Fantastic. All right. Great. That's a good overview.
For me, this is how I manage my money, right? I think, I don't really find this work. I enjoy what I'm doing. And I think even if I wasn't running this fund, this is exactly what I'd be doing and how I'd be managing my money. I think I've come up with something that allows me to sleep at night as I invest through this. It's not a game for 1 year. You're doing this for like 10, 20 years to grow your wealth. And I think I know I've emphasized it a few times. It's all about compounding those returns. So just avoid the drawdowns and let your steady returns compound. And over the long term, you should be doubling your money every 6 to 8 years.
Fantastic. Eric?
Thank you so much, gentlemen. There's so much of experiences and obviously your expertise in the market space that are in. Now, Ash, just maybe putting on my investor cap, and the $1 million question will be why Japan? Why are you so keen to jump on the plane to Japan? We're planning holidays as well, but I think Kay was mentioning that you've got a passion for Japan.
Okay, I think he's coming back on.
Hey,
Hi.
sorry guys, technical disruption as they call it. Can you hear me now?
Yeah.
Okay, cool.
Yeah, we can hear you. We can hear you fine, Eric. I just have a quick question. You kind of go into the Q&A. I'm just wondering how long it's going to be because I got a meeting in about 20, 25 minutes. It's relatively close by, but I just wanted to make sure. So either we keep it within that time or I jump off now and you finish up with Ashvin. I mean, what are you thinking?
No worries. I think we've got a lot of stuff from what you guys have explained and presented. I think just 3 quick questions for the investors that's looking at this.
Sure. Eric, have you? Oh yeah. Sorry. Apologies. I can see the recording is back on. I was just making sure.
Yeah. So just three quick questions because from an investor point of view is, Ash, what you've done is really from experience, you've built a process. It's still a black box in a way. And for a lot of the underlying assets, it is public listed, so people could have direct access. Asians are known to be very hands-on. So what would you say about someone who needs to start looking at something different like yours as an alternative asset class?
Yeah, I think it's okay to be hands-on. I think you look at your whole investment portfolio. I think it makes sense to. I mean, most people, I guess, as an individual investor, you're probably looking at value and trying to buy stocks and bonds, which makes sense. I think it also makes sense to look at the alternative space for maybe 20, 25% of your portfolio for something which is not correlated to what you are doing. Because there are going to be times, at the end of the day, you want to build a diversified portfolio, right? So when it comes to asset allocation, you probably want 20 to 25% in alternatives, maybe some in real estate, some in stocks, some in bonds. But the alternative space is good because it gives you it's the true diversifier. Very often your stocks, bonds, and properties are all correlated to the economic cycle. The alternative space is the stuff that cushions the fall when things go wrong, I would say.
Okay.
And I think that's the way I would look at it.
And Ash, I like the fact that you've got 0% correlation to the market because you're long short. So you're not tied in on a single approach. But from your fund's inception since 2016, were there any negative return on a certain month basis, and what was the reason for that?
Yes, of course. I mean, the fund has, I guess we make money 80% of the time on average. I think if anyone made it all the time, you'd probably have to start questioning how that's possible. But, it's all a probability game. And I think when you do your investment analysis, as I went through just now, it's based on my view of the economy and what asset classes are going to do well. But sometimes things, that you could have a specific risk which hurts the market. Like I could be investing in North Asia, for example, and then there is a nuclear attack, or there's some talk about, there could be some external event that could affect your trade that could cause it to go wrong. The other reason could be my view of the market is wrong. Like this economy, the data is going up and it suddenly turns, right? So these things can happen. It's just about managing the risk when you're wrong. And I think that's very important. You can't be married to your trade. If the data says you're wrong, and you get out of the trade. So very often I don't even wait for my stop loss to get triggered. If my underlying macro drivers that I believe in supporting a trade are wrong, and I realize that, I get out immediately. Every day I walk in, I look at my trades. Do they make sense? Yes. I don't touch them. If they don't make sense, I get out. And when I get out, I could be up or I could down. But it just depends on whether the supporting arguments are there.
Yeah. Thanks, Ash, for the honesty. I think when you're trying to do great things, that it doesn't mean that there's no mistakes. Everybody that has done great stuff learn through the mistakes. And thank you for that. And I particularly like the fact that you are very vested in the funds, unlike others which may be very big names. Because I personally like to get only into companies, for example, that they are still run by their founders or first generation founders because of the passion. So I think good stuff on you and well done. Last question, perhaps maybe it's still a bit of a kangaroo market. It could go both ways. What's your last word of wisdom of last word on financial wisdom for someone who is looking at the second half of 2020?
The way I look at it is there's some things you know with a bit more certainty, and there's some things you know with a lot less certainty, right? So anything around the virus, there's very little certainty. Obviously, you're getting a lot of vaccine results, etc. But the markets are trading around the end date when we get a vaccine right now, because life does not go back to normal until we either have a cure or a vaccine. Or herd immunity is probably unlikely, the way we've contained it. Um, so the steady state that we're probably going to get into, which most countries will have to understand, is wearing masks, social distancing, closing your bars, etc. I think sensible steps that everyone has to do. I think the US is learning the hard way. UK is probably going to learn the hard way after opening up. So we're going to get to a steady state, which is not going to be the same, right? There's going to be less consumption. There's going to be higher unemployment. There are going to be lots of businesses that go under, especially in the hospitality and tourism area. But there are things we know with certainty, right? Stuff like the government is there to support you. Fiscal policy is the new normal. People are just, it doesn't matter how much debt a government has, they're just going to keep going. They've got the green light now because, they may be doing more than they should, but they've got the green light now because it's nobody's fault. They need to support everybody, right? So if you look at the US, the amount of fiscal they're doing is way more than they need to do. But they're going to do it because they have a green light. And, a lot of good things can come out of that once we get out of the virus because they're spending and they're going to change a lot of things. So that we know is certainty. Liquidity and fiscal policy is going to be there. And we know what they're going to support. They're going to support investment grade bonds. We know that there's going to be a lot of money printing. So that's probably bad for the dollar or any other currency in the long term. So gold is probably something that's good, right? As the anti-dollar trade. And we know that asset prices in the long term are probably going to go up because there's a lot of liquidity. And which are the asset classes that are probably going to do well? I think anything with healthcare and tech. The disruption has just been fast-tracked. Whatever was going to happen in 5 years just happened in 3 months. So I think these are the things we know with certainty. Uncertainty comes around how long this drags on, and that's the real economy. And so you could still get the S&P 500. If we are in the same situation in a year, I find it hard to believe the S&P 500 is here. It's probably going to be a lot lower, right? Because profits are going to go down. The way people are buying assets now is because they believe that earnings are coming back next year. I personally believe it's going to be a 2022 story, but as long as people believe, asset prices will stay elevated because there's a lot of money, there's a lot of savings going on, right? So if you look at the amount of savings in the US in particular, where a lot of interest is going into the markets, it's gone up a lot. Incomes have gone up a lot because of government support. Savings has gone up a lot. And when people save and they can't go out and do very much, some of that does trickle into assets like bonds and equities. So I think be careful because if this virus, you just have to monitor this data very carefully. I actually send out a COVID update every week to my investors, analyzing all the mobility data, the mortality data to see the trends. And for what I see, Asia is doing the right job handling this. The rest of the world is going to learn and probably do what Asia does. And we're going to get into a steady state of low growth and high liquidity. So you go for asset classes that do well there. And I would think it's investment grade bonds, tech, healthcare, and gold as the short US dollar trade.
Thank you so much, Ash. Really words of wisdom. I've going back to my basic 101, never fight the Fed and don't get in the ways of the lemmings, especially at the top of the cliff. So I think, human will be human. But again, I think we will benefit much from your wisdom in the marketplace and what you're doing. And we will then be able to share, your new investment approach, that we could be long short at the same time, despite the cycles or the financial market decoupling from the real economy. Thank you, Kay, as well, for putting this together. It's been a wonderful experience. We will be happy to do more and see, on topics that's of interest to investors, but also that, as the market's moving in different direction, perhaps we can regather for another time and space. Thank you, gentlemen.
Yeah, thanks a lot, Eric.
Thank you, Eric. Thank you, Ash. See you guys.
Bye-bye.
Bye.